Okay, so good afternoon, guys. Trust you all are doing good. So, welcome to the third video on the mentorship program. And in this video, we'll be talking about psychology and risk management. Now, I'll be talking about psychology in two ways. Yes, in two ways. Now, there's a psychology when it comes to your emotion, and there's a psychology of the chart, like the whole chart itself. So, let's get right into it. Now, psychology on the chart, I would explain just right now. Yes, I'll go to my trading view chart and explain the psychology when it comes to the chart, to be precise. Now, um have you ever been in a situation whereby you find it difficult to actually understand anything that is on your chart? Like you find it difficult to understand the things you see on your chart, and to some point it start giving you this crazy headache. You don't really know what to do on the chart. Real quick, I would just want to explain a few concepts to you guys. So, in the financial market, we have things called the smart money and we have things called the dumb money. Now, the smart money, hmm, the smart money are the ones making all these moves. We follow the smart money. We are the dumb money, and we have those called the dumb money. Why we are the dumb money? The dumb money are just us, like retail traders. Now, let me explain this concept to you guys. This is what the smart money wants you to see. Like the way price is moving normally, that's what the smart money wants you to see. And this is where they actually target you. Like looking at this now, I know somebody will say this is about to buy to the upside. I won't disagree with you because of it's your sentiment. But what if you can see or view price from a different perspective? Now, another perspective of price. I'll be looking for a naked chart, just an empty chart. Wow, this one is marked out already. That's hit TP, URUSD. My harmonic never got completed. GBPUD seems it's okay. It's clean now. I'm actually looking for buys on this, so take this out now. Look at it real close. This is what the smart money wants you to see. But what if you can view price from a different perspective to understand where it is likely to head to or where it might be heading to? I know it sounds crazy, right? But adding another chart, the same GBPAUD, the same daily time frame. Wow, wow. Delete that and we're good to go. Okay. Now the same GBPAUD but turned upside down. Now I know you might be like, why do you have to turn a chart upside down to know its direction? Remember, your brain is programmed. Like your brain is programmed to just view something and believe that is what you want to see. But what if you can actually control your brain to view it from different perspective? This is the part whereby the whole psychology thing comes in. Now, remember, this is GBPAUD on the right hand side turned upside down, and this is GBPAUD on the left hand side, the normal way price is supposed to be. Now, what does this actually help us do? It helps us understand price in two different perspectives. Now, look at this closely. Dealing with relevance and price, that's relevance and price, yeah? If you throw your horizontal ray on this, you believe that came back to this level and there's another level above here, and price is like in a range bound. The same thing we have occur here, and this will actually give you a heads up to know where price might be heading to next. Because of what? Viewing price from a different angle gives you sight from a different angle. I know if somebody there's somebody that will see this and say this is coming to the downside. Well, if you were able to view it from this perspective, it will tell you to come to the downside, but the downside on this angle is the upside on this. Like real quick, this. So it's best to me, I believe, when it comes to psychology on the chart, it's best to view price the other way around to know where it will be heading to than viewing price the way it's supposed to be. It's just going to shift your psychology like off the market perspective itself. It's going to let you know, okay, everybody is seeing this. What if I see another thing? You have a higher chance of seeing another thing, and that other thing you see playing out rather than seeing what everybody wants to see. It's quite crazy, right? Don't worry, you'll get used to it. More videos will follow this. So with this known now, I believe it has actually changed your perspective about life or about price itself. Now I know somebody say, we that we are using phone, can we actually do this? Yes, you just turn your chart upside down, like turn it upside down. Just turn your chart upside down real quick. You just, possibly you up on card JPY or something H4, then just turn it upside down. Make sure your auto rotation is off though. Yes, make sure it's off so you can actually view it from a different angle. Just turn everything upside down, you get to view price from a different perspective, like massive stuff. That way you understand how price will be projecting, or the likeliness of price projecting to a certain level. Now I hope this is clear and it has actually helped you have another insight about the financial market. And this is called a flip chart. Like turning your chart upside down is called a flip chart. I did not come up with this at all. I didn't bring this up all of a sudden. No, I learned it from Astro FX, because I really look up to their course, or their value they give, the information they share. I really look up to it. So that is where I copied this out from, and I've been using it. It has been working quite well for me, and I believe it will do the same for you guys. So this is psychology on the chart. Now psychology on your emotion. This would be a long hell of a talk, so let's get to it. Now your psychology is based on the person that you are. Like, it's based on you. I will be very, 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 very sincere to you. You can read all the books about psychology. I can give you every course that Mark J.D. Douglas has ever created on psychology, and you would watch everything, and still your psychology based on your emotions will be fogged up. Why? Because there is more to it. It's all about you as a person. It's all about you as a trader. It's all about you. All about you. The type of person you are, your characteristics, your behavior, it's what makes up your own psychology as a trader. I know this industry is very wide. Like, somebody will tell you this today and they'll change it tomorrow, and you just need to stop believing everything and believe few. Those are the mistakes I made in the beginning, and I wouldn't love anybody on the team now to make such, because it would actually fuck them up. It will fuck their journey up. I know a lot of people that they study new courses every day and still they are not doing well. Why? Because of they were pushed by the profits that the maker of that course has made, rather than they should be more focused on the process. I know people who hop on signals, like they go from one signal group to one signal group. They are not traders, they are just followers. So the right psychology about trading can be derived by you. Now, how will you derive the right psychology? I can't tell you how to derive the right psychology because I can't make decisions for you, but I can give you an hint on how I derive the right psychology. Now, a little bit of my backstory. In 2018, or no, in 2019, almost to the end of 2019, I was struggling with my psychology, like as a whole, my trading psychology as a whole. I was having mental breakdowns over and over and over and over again. How did I overcome that? I actually put myself in the circle or in the midst of doers. Like, I created this trading community to put people of like minds together, and that was how I actually was able to overcome my psychology when it comes to the market, having mental breakdowns and all. So that's just a tip. I unfollowed all these things and people that were not adding value. So putting myself in the situation of people I know that my goals are the same as them, my life process is relatively equivalent to theirs. That was how I was able to overcome the whole procedure when it comes to psychology. Now, your emotions will still be like that of a normal human being, but only you can actually shift your mind, put your body, mind, and soul in balance, that you will achieve this state of freedom. Freedom not from everybody, but freedom from yourself. You are an entity, so that is how you can actually be able to contain your psychology about the market and about yourself. Because like I said, the financial market is not about your technical analysis, it's not about your strategy, it's not about your approach, it's not about your psychology, it's about you. It's about you. So only you can build your edge, only you can define your process, only you can build your approach. So that is just like the major thing on psychology. Real quick, just 10 minutes of, I don't know, maybe mind blowing talk or whatever, but that's just the simple truth about psychology. So that's just it. Like, that's it real quick. Now let's go to the part of risk management. Yeah. Now I'll be going in depth into risk management because I've seen situations whereby traders just they trade. It's very crazy, right? They just trade. Now, risk management, I'll be going into take profit, stop loss, downside risk, upside risk, and a little bit on entries. Like I used to say, I can't. I'll tell you how I do my entries, but still, it has to be based on your approach. That's what most people don't understand. It has to be based on your approach. So let's get right into it. Now, risk management. It's derived from two words actually. It's derived from two words. That's risk and management. Now, the funny thing is, what is risk? Let's use a life example, okay? They are robbing on my street. I am hungry. I need to get food. And there's a food seller 4 blocks away. Me going downstairs or outside to go and get food and come back upstairs, that's risk. Okay? You know it's quite crazy, but that's just risk. Like, risk is the a danger or a position you put yourself in that actually will determine an outcome. Now, the outcome of risk is of two ways. It's either in the financial market, it's either blowing or making. Blowing your account or making your account. So that's just it. And management is how you actually the approach you apply towards that risk you take. So risk management combined is a defined process or approach you apply towards taking a step in the financial market, like when you want to take a trade or something. So with that known or that being said, let's get right into it. Now, when risk management comes in play, we have what is called risk to reward. Now, the risk, the amount you are willing to lose. The reward, the amount you are willing to gain. So let me write that out. Risk to reward. Now, the risk I said is the amount you are willing to lose, while the reward is the amount you are willing to make. Very, very easy, very, very simple. Now, for you to determine your risk to reward ratio, you must determine how much you are willing to risk first. Now, how much are you willing to risk? I've seen traders. Now, this is where the part of stop loss comes in play. I've seen traders whereby they just say on every trade they risk 100 pips, and every trade they risk 50 pips. You will die there. Yes, your account, your stop loss will keep on hitting and hitting and hitting. Your account will keep on blowing and blowing and blowing. So how do you set stop loss? How do I set my stop loss? How should you set your stop loss? You should set your stop loss based on structure. Based on structure. Based on structure. I talked about market structure previously. I'll talk about it again. I said we have in an option we have series of higher highs and higher lows. 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 While in a downtrend we have series of lower highs and lower low, lower highs and lower low, lower low and lower highs, lower low and lower highs, lower low and lower highs. Now, if I am to buy, let's say this is GBPAUD. If I am to buy GBPAUD, let's say I get my entry here. Where will my stop loss be? Somebody might say yeah, but no, it's very, very stupid. My stop loss has to be below previous structure, which is here. Now, I know somebody say this stop loss is wide. Yes, number one, it might be wide. Yes, but number two, apply common sense. If my stop loss is here, let's say this is 100 pips, and I've told myself every risk I'm taking on a trade must be equivalent to 3 times of the risk. That means if I'm taking 100 pips stop loss, I must be able to make 300 pips to the upside. Simple as ABC. Same thing applies here. If I should sell here, my stop loss will be at this previous area of structure right here. If I should sell here, my stop loss will be at this previous area of structure right here. If I should sell here, my stop loss will be at the previous area of structure right here. If I should sell here, my stop loss will be at the previous area of structure right here. So that's just like based on stop loss placement. Now my take profits, how do I set my take profits? It's very, very simple. I trade zone to zone. So my take profit is at an ideal area of structure where I know that okay, there will be structure at this area. That is where I'll take profit. That is why I always use what? The Fibonacci tool. If I am selling, let's say I sold here at the 78.6. Let's say we have this occurred. And we had the retracement here. Then let's say it's ended at 61.8. My first take profit will be here, because this is an ideal area of structure, and my second take profit will be here, an ideal area of structure. Why? Because of over the years of backtesting, in every book you read, you hear these are the two levels that price is likely to reverse or react. So that is where my take profit will be. Simple as ABC. Now, what is the best risk to reward ratio to use? The best risk to reward ratio to use is 1:3. Why? Very simple. 1:3. You'll be risking 1 to catch 3 times of that 1. Now, why did I say it's 1:3? Because of it's very simple. If you lose 5 trade, that means you've lost 1% 5 times, and you just take 2 trade and you win those 2 trade. That's what you've made 6R and you've lost 5R. If you subtract 5 from 6, you still have 1R left. That means you made profit. So 1:3 risk to reward ratio is the best risk to reward ratio to use. Like whenever you are analyzing, whenever you are doing price projection, that is the best risk to reward ratio to use. So I hope psychology and risk to reward ratio and insights have been given into it by me, and I do hope this helps you better when you are doing your technical analysis and all. So God bless, and meet in the other videos.